Coming up, Australia's unemployment rate falls, increasing the chance of further rate rises to come, while the US presses pause on interest rates, and China's economy gets even more stimulus. That's coming up. It's your daily 10-minute business and finance news wrap for this Thursday, the 16th of June 2023. Later in market day, we'll take a deep dive into China's economy as its central bank cuts another key interest rate for the second time this week. But first, to Australia's labour market, where the May unemployment rate fell to 3.6%, 40,000 jobs created, and the participation rate reaching a record high. It signals a continuing tight labour market and the potential for further interest rate rises to come. For more, I spoke with Callam Pickering, the chief economist at Indeed.
Well, the labour market remains incredibly healthy. I mean, last year it was breaking records left and right, and despite the challenges of high inflation and rising interest rates, not much has changed. The unemployment rate is roughly as tight as it's been in the past half century. And given the very strong ongoing demand for workers across the nation, that probably isn't going to change in the near term.
What do you think it says about the economy, though? Because we've got some indicators pointing to a softening, yet then we get these strong jobs numbers.
We are beginning to see some mixed economic indicators, which is a sign that certain parts of the economy are beginning to show signs of weakness. The retail trade figures, for example, is a really good example of that occurring. We are seeing weaker consumer sentiment numbers as well. But it's clear that overall, the demand for workers remains incredibly strong, that businesses and business owners must feel pretty optimistic about their economic prospects. Because if they weren't feeling that way, they wouldn't be hiring in these sort of numbers.
A lot has been said about declining productivity lately. Is there anything in these numbers to suggest that, and to what extent is that a concern?
Well, the very weak level of productivity growth that we have seen is obviously a big concern for the economy. In the long term, productivity is what drives economic growth. It's what drives the increase in living standards. So the fact that productivity growth right now is very weak would naturally be a concern for policymakers, both at the Reserve Bank and at Federal Treasury. We need to see that turn around if we want a healthy and vibrant economy long term. And we need that to turn around if we want to see strong wage gains long term as well. Because if you have weak productivity growth, then high wage growth is going to translate into high inflation. And that's obviously not what we want in the current environment.
Given we're talking a lot about that tight labour market, earlier this week, we learnt that a record 927,000 Aussies are working multiple jobs. Today, the ABS said that overseas migration has driven a 1.9% increase in Australia's population for 2022. Should this ease that labour market tightness?
Well, there's certainly an anticipation that very high levels of net migration will begin to ease some of the talent skill shortages that we have observed over the past 12 to 18 months. We're actually already seeing that to some extent. Over the past 4 months, employment has increased by 205,000 people, and yet the unemployment rate hasn't really moved. That's incredibly strong employment growth, and normally if you saw numbers like that, you would expect the unemployment rate to have fallen quite a bit. We haven't seen that, and that's because of the very strong population growth that we currently are experiencing. So the labour market at the moment is strong enough that it's absorbing all of that net migration, helping to fill some of these roles that are available, and the unemployment rate is keeping pretty constant as a result of that.
Over the past few weeks also, we've started to see many more market watchers and economists revise up their expectations for the terminal cash rate. Today's release, given the strong jobs numbers, does this increase the chances of further rate rises to come?
Well, it certainly increases the likelihood of a July rate hike versus an August rate hike. It's important to recognise, though, that an unemployment rate of 3.6% is actually in line with the RBA's expectations when they released their latest forecast back in May. So it's not necessarily a surprising result from their perspective. Nevertheless, it's very difficult to imagine them ignoring the very strong labour market figures that we have seen over the past few months. The RBA has noted that they think further rate hikes are going to be necessary to contain this inflation outbreak. And with inflation at 7% and the unemployment rate roughly as tight as it's been in the past half century, it's hard to disagree with that assessment.
Callam Pickering there, the senior economist at Indeed.
Now, Market Day on the SBS On the Money podcast.
The Australian share market rose today, up 0.2% on the S&P ASX 200, 7,175. That's despite talk of further rate rises here following that jobs data. Also some economic updates from the US as well as China. For more, I spoke with Damien Boey, who's the Chief Macro Strategist at Barrenjoey. Damien, how have the markets reacted to the latest jobs data, and how has it changed interest rate expectations? How soon could we see another rate rise now?
Yeah, so the market has been, looking for slowdown. So to get a fairly strong jobs number where the unemployment rate goes back down and full-time employment goes up is actually challenging a lot of bearish expectations. So making people think about how resilient really is this economy. Now, in terms of what's happened with interest rates, the market yesterday was basically pricing in almost like a 20% chance of one rate hike in the next couple of months. Now the rate hike pricing has gone to basically a 50% chance of a 25 basis point hike next month.
How has the share market reacted?
Yeah, so what's been surprising is that it's actually been the banks that have significantly outperformed today. So you might find this a little bit surprising, given that, we're talking about interest rate hikes and the like. I guess the narrative might partly be that it's not as bad as we first feared in Australia. Maybe that's part of it. Maybe there's a bit of pessimism also about China. So China has basically announced engagement with the private sector as to how it can stimulate. And some people read that as a good sign. Some people read that as with a bit of skepticism. So to the extent that there are some concerns about China, which the market is showing today, because resources aren't doing that well, maybe there's been some rotation into the banks.
On China's factory and retail sales growth missed expectations today. It supports moves by the People's Bank of China to stimulate the economy by cutting various key interest rates. Another one was cut today. What's your take on China's navigating its path out of COVID and its implications for global growth and for Australia?
Yeah, so if China can get itself up and running again, this will diversify the global growth mix. So no matter what you think is happening in the US or Europe, if China is actually going okay, then the overall pot of world growth will still be looking softish, but still reasonable. And that might be enough to sustain some optimism in markets. Now, in terms of, the issues that China is facing and what could they do, I guess after COVID, people were expecting that with reopening, the recovery would get a life of its own, much like it has in the developed markets. COVID and reopening just happened to be the gift that kept on giving when it came to economic growth after the lockdowns had ended. But it was really interesting to see that in China, the reopening bounce kind of came and it went, and it was fairly short-lived, all things considered. And so people have started to ask themselves the question, is there something wrong with the plumbing and the mechanics of the Chinese growth engine? Is it a lack of confidence in what policymakers are doing? Is it such that policymakers simply need to show a little bit more conviction about wanting to stimulate? Are these the sorts of things that we need? Now, at the beginning of the year, China basically got rid of its 3 red lines policy, which basically was weighing on the property sector. However, what you've seen with a lot of the property market lending that's been happening is it's been going to finishing incomplete projects. A lot of that lending hasn't quite made its way yet to home buyers. There haven't necessarily been reforms to help housing affordability. And if housing turnover in the Chinese markets doesn't get going, then you're looking at local governments and local government infrastructure vehicles who are very heavily dependent on the property sector for life. And people start to question solvency, debt servicing, and things like that. Once you start to get those sorts of concerns set in, then people start to worry about, well, is China going to experience large-scale capital outflow? Will that undermine what Chinese authorities are doing, et cetera, et cetera? So that's kind of where China is. And most of the recent feedback about China that we get and other people have been reporting is actually pretty bearish. Now, our take on that is that it is actually a little bit more conviction is required from policymakers to stimulate in the right areas, to gain traction with the private sector, who is somehow doubting what's going on. Now, I believe they can do it. And I also believe that Chinese policymakers will be given the benefit of the doubt by foreign investors. And the reason for this is very simple. In the past, whenever China has eased, investors have typically looked through the easing to the bad news driving it. And the reason why they do that is because the yuan comes under devaluation pressure and you see capital outflow, and the capital outflow undermines the liquidity conditions that you see within their economy. Now, what I think is going to happen is that the Chinese currency is actually slightly undervalued now. It's no longer overvalued like it once was. Inflation in China is lower and interest rates are higher than where they are real interest rates are higher than where they are globally. So to the extent that the Chinese currency has support, to the extent that you shouldn't be getting this capital outflow, if policymakers in China can simply arrange a credible package, I think that the market will go for it. And I think that it will bite for their economy. And I think they can get their growth engine going again. There's a lot of ifs and buts. People want to see tangible evidence. They want to see specific proposals. But I think yesterday, in particular, when Chinese policymakers allowed the public to see that there is actual real engagement with the private sector to get this going again, I think that's good news.
So from one of the world's biggest growth engines to the world's biggest economy, the US decided to leave official interest rates on hold overnight, but there is still a risk that rates will go higher there, isn't there? What's that then saying about the global environment? Because at the same time, we saw today a much smaller economy, that New Zealand's economy entered a technical recession.
Yes. So I think what counts as a recession or what counts as really bad news for central bankers kind of needs to be put into perspective. So the US economy has been holding up reasonably well against quite a lot of bearish leading indicators and a lot of expectations to that effect. So what's happening there is you've got this dynamic where as you raise interest rates, you help savers. You don't really hurt the existing borrower because they're all on fixed rate mortgages, and you might hurt the marginal borrower. It's a very equivocal policy mix. And it's unsurprising that as you raise rates, the market might think that you're going to break something, but actually because you're helping savers more than you're hurting borrowers, it's actually a fairly benign impact of tightening on the economy. And there are a whole lot of other post-COVID developments which are happening, which are still supporting the US economy. So my understanding is that global central bankers are willing to tolerate even slightly negative growth for a little while, but nothing major to really drive up the unemployment rate or to break credit markets or the banking system. So the pause that we've seen really is a pause to take stock of everything that happened in March with SVB, with tightening liquidity, and even the resolution of the debt ceiling could be a little bit complicated for money markets. But once a lot of that uncertainty is kind of resolved, or at least resolved to the Fed's satisfaction, they are still incredibly concerned about high inflation. And one of the issues for them is that rental inflation is still very elevated and unlikely to come back to their target on a reasonable timeframe. So therefore, they need to continue raising rates. The market is currently saying that we don't believe you, Fed, when you say that you're going to hike twice more this year. And the Fed is adamant, no, that's where we're going.
Okay, lots there to consider. Finally, very briefly, where do you see the investment opportunities for investors at the moment?
Yeah, good question. So it depends on your horizon. If you're an Aussie equity investor and you're positioning for the next, say, 3 to 6 months, then the best places to be are in insurance, because insurance stocks actually benefit from higher interest rates. The second thing that we think is actually going to be a good opportunity here is resources. So we actually do believe that Chinese stimulus will gain traction. It is a dicey proposition. There is maximum bearishness about China at the moment, but therein creates the opportunity to be different and to be a bit more positive. So insurance and resources are where we see key overweights. If you're a longer term investor and you're concerned that central banks are going to really push the envelope here, obviously you might want to be a bit more defensively positioned. But right now it's insurance and resources for us.
Damien Boey there from Barrenjoey.
This SBS On the Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial